A slow motion crisis may be unfolding in the commercial real estate market due to the combined impact of higher interest rates and lower demand for office space. Almost a perfect storm. Our next guest says the Fed raising bank capital requirements will cause even more disruptions for the commercial real estate and housing markets. Joining us now is Daniel Walsh, Citymark Capital CEO. Dan, years of experience you've had in one of the great state of Ohio. Let's just call it what it is. But they're like super regionals, I guess, Key Corp, Huntington, place like that. And a lot of your expertise has been in both managing and doing some workouts for real estate portfolios over how many years? 30 years or so?
Close to 30 years. Thanks, Joe. Thanks for having me this morning. Much appreciated. But yeah, that's about the period of time over the last nearly 30 years, 20 years in regional banking, and then last close to 9 years as a private equity investor in the commercial real estate space.
How bad is the situation now? And I called it kind of a perfect storm when you think about, the post-pandemic world, zero interest rates for a long time. I mean, we don't hear toxic assets, really, Dan, like 2000, like before the financial crisis. But these loans got to be underpriced for risk, and especially after what the Fed's orchestrated.
I think that's right. I mean, there is quite a difference between now and 2008. During that time, you did hear about toxic assets, the CDOs on CDOs, and, just kind of an unknown bottomless pit of potential losses during that period of time that needed to be sorted out. I think we're in a very different time now. I think there's been great discipline with the banks in terms of how they've underwritten loans. But the reality is that, we've seen this flash freeze, if you will, in the banking space where, rates had this breathtaking increase. Which had to be done. And I think the Fed's done a great job controlling inflation and getting us to a point now where we have to kind of start to sort things out. But, what's happened with this rise in interest rates is that borrowers and banks have to now try to refinance in a market where there are, $1.5 trillion of maturing loans over the next 18 months. And so during that period of time, you're just going to have some stress that they're not toxic assets. They're well underwritten. Banks didn't get carried away with leverage, but the values have dropped because interest rates have gone up.
And so what's that mean for so 1.5 trillion? Obviously, it's a totally different world than when the loans were first written. So I think in your view, it's going to hit some of these banks. They're not going to be able. You say they're not going to really issue stock. That'll be too dilutive. So you're going to see loan sales at below market, or not below, but at market prices, which are going to be way below the loans themselves, what they were issued at.
Yeah, I think that's right. I think that there's a lot of capital lined up and kind of salivating over the idea of buying bank loans. In my experience during the last downturn, I don't think banks are going to be in a position or want to sell big blocks of loans into the market. I think, again, because they've been disciplined, there are loans that are going to have refinance shortfalls with borrowers who will not be able to repay those loans. Loans will get downgraded, and the more capital that gets put against those loans make them unprofitable. So it becomes kind of a clinical decision for banks to go ahead and sell those loans into the market. But I think they'll do it in a more surgical way, where they'll look through their book and make sure that they're not going to dump them into the market, because I do think that will also spook the market. I think right now when you look at SVB or Signature, those loans have gone kind of en masse into the market to be sold. I think banks are going to be a lot more thoughtful and sell them in one-off and in small batches, which is what we did, frankly, in the 08 to 10 timeframe, and it worked out well.
So what does that mean, Dan, so the Fed's job might be easier because this will cause some credit contraction, right? It sounds like on a scale of 1 to 10, it's not that serious an issue. We talk about commercial real estate like there's a looming Titanic-sized iceberg that the economy is going to hit. You don't think that?
I don't. I mean, I think you're right. It is deflationary, right? Right now, and I think we're in the early innings of it. Banks, if you think about SVB failing in March, the Fed had to, and the OCC had to think about the guidance to banks in the second quarter. That got rolled out in the early third quarter, which we're in now. So I think banks are really trying to get their arms around it right now. But I do think, if you look at the typical, especially the kind of the larger regional banks, if you look, banks across the board have about 13 to 15% of their loans are commercial real estate loans across the whole, banking universe. And most regional banks are at or below that amount. and they will definitely have loans to sell, but it won't jeopardize those banks.